Okay, well, welcome everybody to the industrial breakout session here today. I'm Adam Marshall with Newmark. I'll be moderating this esteemed panel of industrial real estate experts. I'll just do a quick introduction here to our panelists. To my right, we've got Elba Colavitti of Clayco. Elba is a senior design associate at Clayco with more than 20 years of experience serving global and Fortune 1000 companies in the industrial and commercial markets. Elba is involved in all phases of the project from design through construction, and as an architect offers particular expertise in the design of manufacturing, distribution, and warehouse facilities. And we've got Kyle Grant, who's a vice president at Venture One Real Estate. He's responsible for the leasing of the firm's 8 million square foot portfolio, while also assisting in efforts to expand their holdings through new acquisitions and development. While at Venture One, he has completed over 350 leases totaling more than 12 million square feet. And prior to Venture One, he was part of the acquisitions team at LaSalle Investment Management and KTR Capital Partners. And then we've got David Conroy, who is a partner in the industrial division of Cawley Chicago. He's completed a variety of transactions, including tenant representation, investment sales, and asset brokerage. He's performed a variety of tasks for clients, including lease renewal negotiations, new lease negotiations, facility acquisition and disposition, site selection, investment underwriting, and construction and development consulting. Today, Mr. Conroy has been involved in over 5 million square feet and 150 plus acres of land transactions valued at over $250 million. On the end here, we've got John Joyce, who serves as a managing director of SVN Chicago Commercial's Industrial Group. His focus is on providing real estate and supply chain solutions to distribution and warehouse companies throughout the Midwest on matters including relocations, consolidations, site search analysis, build-to-suit alternatives, incentives, acquisition, disposition, and leasing services. In 24 years of service, he has completed more than 1,000 real estate transactions in excess of $750 million in consideration. And John also has experience as an owner himself, acquiring multiple industrial assets. And this unique experience has greatly enhanced his ability to advise clients in his agency assignments. And remotely here, we have Ed Wabick, who is a principal at Payne Wetzel and has achieved a successful track record in commercial and industrial real estate brokerage since 1986. Ed has consistently been one of the top producers at Payne Wetzel and is a leader in the commercial and industrial real estate industry. He specializes and has extensive knowledge in the city of Chicago, plus the West, Southwest, South Chicago suburban areas and Northwest Indiana. So let's get started. First question is for Kyle. The market has experienced dramatic rent growth this past year. How do you quote lease rates to tenants in such a rapidly changing environment, and what other lease terms have changed?
Yes. Can you hear me? Yep, there we go. So I think long gone are the days of 2 to 2.5% escalations. I still do think, as far as rental growth rates go, you're seeing a lot of quotes or initial proposals go out at 3%, but I just think landlords now have a tendency to hold firm at 3%, where 2 years ago that would more times than not be one of the negotiation points. I think I've heard a few landlords, we are starting to do it on some select properties, go out at 3.5% to 4%, and then based on other deal points, decide how firm we negotiate that. And then I forget what the other half of that, but was.
Yeah, where do you see rates? Do you see an increase in rates? Are you able to push rates so with tenants depending on the?
Yeah, so I also do think, and then I think another component of this is, as far as proposals go, we always give, somewhere between 3 to 5 business days of response times. I think that you're starting to see in really active properties or vacancies we have, really needing to hold firm to those, expiration dates on those proposals. We've had a few properties. We have a spec building in Glendale Heights where, we had 4 or 5 groups looking at the same space who were responding in, 24 to 48 hours. I think the days of being able to take a week or two to, get 4 or 5 RFPs back when you're on the tenant rep side and analyzing them all and then sending responses back, 2 weeks after the landlord initially responded and expecting all the terms of the initial proposal to hold firm are also gone on a majority of the properties, especially in infill locations where there's very few availabilities. So that's another just big dynamic change we've seen in the landlord rep side. And on the landlord side, as far as rental rates go, I do think they're going to continue to escalate. When you look at markets like O'Hare, where there genuinely is no new construction availability under 100,000 square feet, you still do see tenant demand there. There's I think 100,000 square feet under construction now, with a few other larger 300,000 square foot buildings planned, but a lot of those have pre-leased already. You're going to continue to see tenants that want to be close in to O'Hare or that infill location start to look and expand in some of the surrounding submarkets. And having property and availabilities there, you'll start to see the same rental growth that you've seen, I think, over the last 12 months in O'Hare trickle out to the Central DuPages or the South Lake counties of the world as well, which we've been a big investor and believer in, is trying to be as close in as possible to those infill markets.
Great, thank you. So the next question is for John. John, how do you advise clients in regards to sale price and lease rate expectations? As Kyle mentioned, and a lot of people have talked about today, just how quickly the market is moving.
Thank you, Adam, and thank you, Ernie Abboud and Mark Menzies and the Illinois Real Estate Journal for putting this event on. So when going out to the market and putting broker opinion of values together, a strange phenomenon that I've observed is owners are thinking of numbers that are lower than the market. So we actually have to talk them into higher prices. So I've been doing this for a while and I've never seen that before. So price expectations on the seller side are being exceeded. So that makes it fun, easier, interesting. And then if we're out with a tenant out in the market looking to lease space, we have to prepare them for what we sticker shock. They're used to consistent rates, haven't increased in decades. Small 2% increases over long periods of time. Now, like Kyle was saying, 3.5% increases on annual increases. One deal was done at 4.5% annual increases. Here, year over year, $1 per square foot net increases is a big jump for 1 year. So that might be 15% for air freight buildings, possibly 20% if you can secure one. In one instance, one of the major developers, international developer, just put it was like a bidding contest, make your best offer, because there are 5 groups looking at one building over on the west side of the airport. And the winner won by a dime. So it's like people know the market, and to secure these spaces, they need to act quickly. So like Kyle was saying, you don't have 2 weeks to think about it anymore if you want to get the deal done. Then on the investment side, have seen, cap rates on I think I know what your next question is on cap rates with Class B properties have compressed from the beginning of 2021. We're 8 to 9%, and today you go out to the market, it's low 7s, 7.25%. So that's a big change. And then we're seeing a lot of new buyers coming to the market that were focused on maybe apartment building portfolio work or office or other businesses, vacation rentals, and they want to get in the game on industrial because it's a hot market. And so they see that cap rates are too low for let's say multifamily, and they have a better opportunity to be successful in industrial.
All right, thanks, John. So David, John mentioned cap rate compression in this dynamic market that we're living in. How has the pro forma changed when assessing investment and development opportunities?
Yeah, I think we've talked about all the tailwinds in industrial today. So I think to touch on real quick, maybe 2 of the headwinds in the industry right now is construction pricing, which obviously is kind of all over the board. It's hard to pin down and going up. And then the other headwind that's potentially coming down the road is the 2 or 3 interest rate hikes this year. And I actually kind of disagree with the philosophy a lot of people have, at least for the industrial market, that cap rates are going to go up with those hikes. I think they'll stay largely flat, at least through 2022. And that's just due to the amount of capital that's chasing all of these investments. So the obvious answer to the question is the pro formas are getting a lot better for these industrial owners. And part of the reason I think the cap rates can stay lower, especially on some of those B and C portfolios where we've been seeing, historically it was kind of a 6 to 7 cap depending on the location and product type 12 months ago. Now you're seeing some stuff that's, in the low 5s to high 5s, low 6s if it's lower quality assets. And the reason is kind of what we've all talked about is we're guiding a lot of our investors through underwriting as they're looking to acquire portfolios. Rents are going up, right? In a lot of cases, you're inheriting a lease that was signed 3-4 years ago, and those tenants that are in there and locked in for maybe 2 more are 10, 15, 20% under market in cases. So there's a huge opportunity over the next 2 or 3 years as you buy those portfolios that if you're going in and you're buying at a 5, you kind of scratch your head and say, how do they make that work? It's because on the back end, they know they can raise rents 10, 15% in the next few years. And the demand is there underlying in the market. So from a pro forma standpoint, I think, what we've seen is pretty much everything is behind industrial right now. Rents are up, escalations are up. And so it's done nothing but help the underwriting. And I think that'll continue to keep, even if interest rates go up this year. My opinion is that, cap rates will probably stay at a minimum flat, if not potentially go down. But I make my living on transactions. So I don't know, maybe Kyle has a different thought since I'd
piggyback off that on a lot of conversations I've heard, at least this morning so far, has been around cap rates. And people think a floor is a 4 cap or something. At the end of the day, a cap rate's just, a specific moment in time, a yield on an in-place rent. There's 100 other factors that go into that cap rate. It's very hard just to take a deal at an in-place cap. We were looking at, we just did our first, 3.5% escalation, 4% escalation lease, in the last few months. And, I would still bet you, even when those leases come to roll in 3, 5, 7 years, they're still going to be under market. We track all of our in-place leases and what we roll them up to. And a lot of times we'll give a deal to keep a tenant as opposed to taking a space back and releasing it at what we call, a market rate. So, there's a slight discount, but we're still getting close to 20% on average increases over the previous lease expiration rate. Future buyers are looking at that as well. And as we look at OMs from, the CBs, the Cushmans of the world, where they underwrite aggressive market rents, but they'll use 7-5%, in year 1 and 2 market rent growth rates for their MLA assumptions as well. Where you look at sort of the average roll, everyone's underwriting 10, 15, 20%. Rent bumps when leases expire. So that 5 or 4% in place cap rate today, very well could be, a 5 or 6 cap on market, or it could be a 5 or 6 cap. If you look at your 5-year hold, your average, NOI, it could be a 5 or 6% cap rate on that as well. So it's hard to take a 4 cap on today's rent and just only look at the deal in that light.
All right, thanks, guys. So to switch to the user perspective in the market, this question is for Ed. Ed, with the heavy demand for distribution space right now, what new markets are gaining developer and institutional interest and why?
Yes, thanks, and I appreciate being part of this. So anyways, I'm going to be talking about the kind of the Southwest and Northwest Indiana market specifically. So, the I-80 market has always been, more of the Joliet I-55, I-80 market. Now that has gone into markets into Cook County, which a lot of developers and users wanted to stay away because of the tax consequence. But, there's development now along that corridor in Cook County, driven by the Class 6B, plus I think also Amazon, but also in real estate location, you can't make a mistake with location, and being off of I-80 and regional distribution and also have Chicagoland distribution speaks for itself. So I think, obviously that market has, the South Cook County market has really enjoyed the last 2 or 3 years. Basically 3 or 4 years ago, I couldn't get a developer to look at sites south in Cook County, but that has changed and for the best. Talking about Indiana, Indiana has been a slow moving, always been consistent deals over there. It's always been thought of as part of Chicago, the Chicagoland market. However, it's been very difficult to find sites right over the border because of the heavy industrial nature, which is unlike, the Southeast Wisconsin market, that type of market, where you get more greenfield sites. So we've been working really hard. A lot of developers, the local people in Indiana and brokers that work that market to develop sites. So right now we have in those areas, East Chicago, Hammond, new development. We're building with Misner a 250,000 square foot spec building. Walls are up and possession will be early next year. But also we're seeing, I've always said people wanted a step in Indiana, but now people are jumping into Indiana more and more so, and going out to Maryville, Portage, and beyond. So Indiana's looking quite, the upcoming market here. And I think my experience has been is that more developers and institutions want to know about it. There have people that, have developers and institutions that are moving forward in there. And I think there's going to be more as we move ahead and start building these buildings, lease them up, and go through the process of, reselling them at a cap rates and things like that.
All right. Thanks, Ed.
I just wanted to add something to what Ed just mentioned. In Northwest Indiana, there's almost no existing inventory available. So these developers that are lining up on I-65 and in Portage County and so forth are going to do very well. I met with the Indiana Secretary of Commerce, and Indiana went around the world and met with 64 countries, and 63 of those 64 countries signed up to do projects in Indiana. So I believe that I-65 is going to be expanded to 4 lanes in each way between I-80 and Indianapolis. And you're going to see a lot of development, we're already seeing it in Maryville, but in Crown Point and beyond. And those buildings are going to do very well. And Ed, if you can help us with net rates, are they 650, 675 net on these new construction?
Well, I think, I guess what I would say is they've always been lower than Illinois. We always compared, because there's really not a lot of comps. So we always compared them to, say, Will County, right over the border. And right now we are competitive in Indiana with Will County. But yeah, we're in that 650 a square foot range. And, so that I think we're right there. And in fact, in some cases, for more specific type uses, we might be even a little higher, but that's a good range to use.
Thank you.
All right. Well, the next question's for Alba here. Due to supply chain disruptions, how has the construction material shortage impacted commodity pricing and timing? And more so, what specific components are impacted the most?
Hi, everyone. Thanks for having me. Well, the disruption of the supply chain started with the toilet paper, right? We didn't have enough of that. It was only 1 week or 3 week supply that we had. And then we had the wood shortage as well. That became a commodity and everybody started buying it because they started getting panicked about the fact that there was not enough inventory. And here we are 2 years later, and precast is 40% up. We cannot even find a roof to buy because there is not even a place to find it right now. We don't even know the price of it. So yeah, there has been a very big disruption with, excuse me, with all the materials. But right now, if you want a building and you get a contract, you will not get a building done until the beginning or start the beginning of next year. It's not just going to be, I'm not going to be able to give it to you. I'm going to start the building at the beginning of next year. So it has been a very big problem. But because last year, nobody was spending money. Now the money is there and everybody is ready to go. So we'll find it. We'll find the materials. We'll find the labor, because that's another problem that we have in the supply chain. There is not enough people that are, they have the skills, right now. Like in an earlier panel, they were saying the labor people are retiring, and there is no one in that gap. Everybody went to college, and now there is nobody taking that spot. So we have the veterans that are going away and retiring, and we have the new blood and nothing in between. So that's another one of our big supply chain problems, because it's like the chicken or the egg, right? What is first? Do we have the materials, but we don't have the labor, or we have the labor, but we don't have the materials? And that's a vicious cycle. But I'm thinking that in the future, this is going to start. Well, now exactly what is happening. It happened yesterday with the rates. I'm thinking, and this is just my personal opinion, that things are going to start settling a little bit more, and things are going to come into a more or a nicer pace.
And just to jump in there. Just to jump in there too, I think there's two sides. The construction industry within our industrial real estate is, there's obviously the new spec construction that you have a lot of experience in, and then there's also existing building, TI build outs. And we're really trying to think ahead of, and make sure that we're taking into account these lead times and educating tenants as well. I am starting to see, I would say the first half of 2021, I don't think every tenant was fully aware of the lead times and delays. I think they were seeing a lot in their industry, but they weren't connecting that to our industry as well. It seems like it's clicked in the second half, where tenants are starting to get ahead of lead time items, and or at least cognizant of it. But even a week ago, we had a tenant that was trying to sign a lease in a new spec building of ours, build out about 3,000 square feet of office, demised the suite because it was only a portion of the building, and be in by March 1st. I think those days of being able to do that are gone. I honestly think we'd struggle to even have a permit by March 1st at the rate. Some municipalities are, they're having the same labor issues you hear throughout of, just reviewing permit sets and getting those approved. So it's really across the board. It's something that, we're trying to talk through and just set expectations before entering into leases. And I think brokers are doing a good job as well, educating tenants for the most part, about those lead times. But we're really valuing building out spec office or doing make ready improvements prior to a tenant showing up. So if we do find someone who needs it tomorrow, we can actually capitalize on that, as opposed to telling them that we have to wait 2, 3, 4 months to do a build out for them.
I'll echo on that with a story too. I think it's a great point that not only is it new construction that there's issues with labor, but also build outs of existing spaces. So we had a tenant that is moving from California to Illinois, and their lease is up end of next September. And so we hit the market kind of right around Thanksgiving time, and we felt that we were a little bit early. But there was a couple spec spaces that they liked on the market. And as the deal evolved, we kind of ended up having a signing for, we have leases out for a July 1st occupancy, which they were thrilled with. And we never thought we'd be able to get something that far out. But the reasoning is that even though the building was finished, there was no spec office, no bathroom, so it wasn't ready for occupancy. And the landlord pretty much came back to us and said, June 1st works, because we might not be able to even deliver it till June 1st at this point. So I think in talking to the tenants in the market, waiting 2-3 months out before your lease is up is a really bad idea. I think planning even earlier makes a lot more sense now. And then also to the point of increasing rents. I mean, we initially toured that building and were kind of quoted 750, high sevens net, and the ownership changed hands, and we ended up kind of settling at 820 a foot because the TIs on the office build out came back so high. So I think starting even earlier is really, really important for a lot of tenants that are out in the space.
I can echo that on some of our spec buildings. We're, taking proposals in now that commence upon substantial completion of the TI. And, we're looking at June 1, sort of plus or minus start date on that. So, if your lease is expiring end of July and, it's to us, it's not looking like that's, 7-8 months of downtime anymore. It's, just about in line with the tenant that's ready to go as soon as we can complete the work.
One item I wanted to add is I did receive some updated statistics. So the fourth quarter was just phenomenal. So some of the statistics we heard earlier today were just through the third quarter. So vacancy is at an all-time low at 3.5% market wide. All core markets improved. That never happens. Usually there's some weakness. Leasing volume shattered all records with 64 million square feet reported in 2021. Net absorption was at all-time high at 46 million square feet. So I think earlier today we heard 33. That means 13 million square feet in the fourth quarter. And that includes user sales. I believe Top Line Furniture acquired a 600,000 square foot Toys R Us facility in Joliet. They add to those numbers. 21 million square feet of new construction was delivered in 2021. I think that's a record. 53% of that was speculative developments. 24% was owner occupied, 23% build to suit for lease. So basically there's a land rush from the developers, and a couple areas, tertiary markets are doing very well. Palatine, Midwest Industrial Funds is putting 200,000 square foot facilities up, and leasing is very strong on that development. West Chicago, I don't know who's doing it, but there's Adam, you probably know, there's some new developments going up there. So it's just, there's no end in sight at this point.
No, but just, I hadn't heard the fourth quarter numbers yet, but, 46 million on net absorption, just for comparison's sake. I think last year we were about 15 million, which I do think was muted due to, Q1 and Q2 or Q2, I guess I should say, was, much lower just based on people sorting out the pandemic. Typically 18 to 20 is a typical number, and, construction, while at 21 is, a hair higher and probably a record, but, I think construction on average year over year is about 20 million as well. So, you're seeing, and sort of what all goes back to the rent growth that we're seeing and what's driving this. It's really just, market fundamentals, but, there's 46 million square feet being absorbed and only 20 million square feet, 21 million square feet being built. Net absorption's through the roof, but new construction's remaining relatively stable. I think the challenge is, it's getting harder and harder to find land sites. I know that's everyone that's coming into the market, and you talk about, new investors. I do think that there's more appetite than ever for, developers, and, we see it with our development arm, but, people wanting to partner on the development side as opposed to buying, just existing portfolios. There seems to be more appetite than ever for development because of that.
Yeah, my source was George Kutro from JLL and Craig Hurwitz from Colliers, and I think their consensus is that 2021 could be the best year ever, but who knows? I mean, it's just phenomenal.
So, what's interesting, right, is what you guys were talking about is that, Class A is driving this new construction, speculative construction. I think this question's for John. How does that trickle down into B and C product? Is there much availability in those types of buildings, and is the demand just as strong?
Sure is. Again, there's just such limited supply when companies go out to the market. Like I was just talking to a broker yesterday about a property over in Niles, and it was on the market for sale, and they found a buyer, and they just couldn't convert with the purchase and sale agreement because they can't find another space, and that's like Class B. So for a number of reasons, different industries are just expanding, and there's very little available, and 10 to 50,000 square foot spaces. So again, rent growth is what's happening. So limited.
I'd reiterate that I do think it under 10,000 square feet, you can still find Class B availabilities, especially in markets, that like O'Hare that you hear are historically tight, but once you get above 10,000 square feet, we had a 28,000 square foot building that we're in the process of completing make ready on, 15-foot clear masonry Class B building. And we during our make ready, the first lease came in at a rate that we were excited about. Did the lease, and we're starting now to do subject to offer because of this. We only had one space left, half the other half of the building. That second rate, because it was the only availability left, ended up being 75 cents a foot higher than that initial lease we did. And these are in a matter of 4 weeks of each other. And it purely was because that one space, there were 3 or 4 groups that really wanted it, were fighting over it. And it was the only, functional 14,000 square foot space in O'Hare at the time that, all these groups decided was the space that they wanted. So you were able to get a 75 cent, which is, close to probably 8% rent premium over a lease we did 4 weeks prior because of that.
I know we are short on time here, but one developer I'm working with, we're under contract on 2 manufacturing buildings, and his intention is just to divide that up and to turn it into a multi-tenant flex space because it can pencil out with, near North Shore areas where rents could be $13.50, $14 per square foot gross, modified gross. And that's a strategy there. For a long time, people just couldn't build these little incubator buildings because they just don't pencil out. The rents weren't there, but that is changing. Northbrook is sold out. There's nothing. People just have to stay in the space they're in or go out of business.
Yeah. So go ahead.
Yeah, Romeoville and Joliet as well. There's nothing available over there either. So they have to stay where they are.
So obviously the lack of supply is creating tremendous demand for new construction, new spec construction. This question's for David. Where do you see developer interest in land, and how does land pricing compare across the market here in Chicago?
I think the easy answer is it's going to go up. But the reasons are all the things we've already talked about, right? I mean, the rents are kind of increasing. We've already seen in O'Hare, and O'Hare's usually the first market since it's kind of the core of Chicago, where you start to see rents go up on new construction, B stuff, and then everything else kind of follows as long as the demand continues to permeate from the center there. So we've seen land prices kind of get up into the $30 a foot range in O'Hare on some of these newer projects. And probably 2 years ago, they were in the mid 20s. A couple of years before that, they were in the teens. So it's gone up and up and up. And I think if you look even to, like John was talking about before, you look to West Chicago, used to be able to throw a dart and hit a land site that you can build on. That's not the case anymore. There's a lot of water access challenges in Kenosha County. So even if you look at a map, you would say west side of 94 seems like it's wide open, but there's incredible challenges with getting access to water. So a lot of that land is kind of out of play, at least for the moment, until some large infrastructure projects go in. And I think you see the same thing down in I-80 with a lot of the municipalities getting together and kind of putting a moratorium on construction. So there's less sites to find, and all the metrics to support the underwriting on these deals are getting better. So I think we'll start to see the growth in land price in some of the outlying collar counties and more, tertiary submarkets even over the next year, 2 years, as developers look for new places to go since they can't find land in places they historically have been able to with relative ease.
And I want to say something about that too. And the lack of land is also going to get into the existing facilities, right, that we have. And they're going to be, and I've completely forgot my point that I was going to make, but there's going to be, and instead of going to have a space that is going to be horizontally, like we know that the million square feet can be a Sears Tower, they're going to go up at some point. I don't know if you guys have found that in your clients, but Amazon is the Amazon effect, right? They're already doing their buildings with a 40-foot clear. And if
I've seen a 160-foot proposal come across on a land site we're trying to sell right now. We're kind of in a one of 3 sites a group's looking at. I've never seen anything like it. So yeah,
instead of just going flat, we might go up, and and Amazon might be the Amazon effect. I'm not sure that that's what is going to happen, but that's my opinion, and that's what I've seen so far.
And Elba, kind of following that line with the vertical height, right? Are there, say there are other design features or layouts that you're seeing, in today's market?
Well, not specifically to the height, but it's to the floors. They have to be a lot. The specs for the floor are a lot flatter. If you want to, if that's a word, I'm not sure. They have to be a certain percent flat, and we have been doing doctoral. Yeah, thank you. Thank you. Yes. And that has been an amazing product to work with because we also have fewer joints so the slab will not break as easily. Also, our clients are asking for air conditioning buildings instead of having just the HVAC, the heater units, just to have a little better environment for their employees, so the employees can feel like they are not in the heat during the warm weather months. The other thing is the roofs, like in the south, we're starting to use, or it has been a thing, the TPO, the white roofs, so they can get the heat out of the buildings and can use the ventilation system, but even then they're doubling it. Like if, for example, in the past was one change of air per hour, now they're doing 2 hours. And don't quote me on that, it's just something I can't remember the exact numbers, but that's what we're seeing now in the new construction to make it to more appeal or like for the people to start coming to work and have more commodities in industrial buildings, not just in offices, but they're trying to make the buildings a little more livable. I'm not sure what word to use, but a little, so they get more comfortable working in the warehouses and distribution centers and manufacturing facilities.
All right, thanks, Alba. Ed, what types of specialized facilities are in demand right now, or new types of specialized facilities that you're seeing in the market?
I think, besides obviously warehouse distribution, or that it's the manufacturing end of things. Obviously, steel in the last year, their businesses are all expanding. I know of at least 5 groups that are out looking for 150 to 400,000 square foot crane buildings. We've had, food processing, cold storage. I don't know if David, you were talking about when you're talking about 160 feet. We've looked at deals for some of these cold storage that need approval for 160, around 150, 160 foot high, because they want to, do the high cube storing. So, food processing, cold storage, steel related, vertical row. We've had a couple of those people out there looking at sites. So I think those are the, off the distribution. We're seeing a lot of that, but just, manufacturing overall has done well because they've got to make the product in order for Amazon and them to distribute it. So, but, food in our market, food has always been a, strong attribute. I don't think it's anything different, but we continue to see that growth.
And Ed, just a quick follow-up. Do you see rail as being a big component to this, particularly on the manufacturing side?
We've been seeing more people that want rail, and rail is part of their deal. I've been doing this 34 years, and I've done 4 rail deals, and probably been acquired to do, probably had requests to do 50, and it always seems like those deals don't happen because of cost of getting rail and things like that. So they build their facilities and just get their product out of the, have a truck from the intermodal yards. But rail has, I'm seeing more and more rail uses from distribution to manufacturing, steel, plastics and paper goods as well.
All right, let's, question for Kyle here. So as we look into 2022, what types of investment opportunities are you seeking, and what does the landscape look like for those types of opportunities that you're chasing?
Yeah, I think it's a lot of the same. To summarize it up, we still are chasing land sites for speculative, developments that we can, are actionable today. And then we're also still looking at a lot of existing portfolios, one-off buildings, sale leasebacks, user sales, and whatnot. Those will really range from, Class A to, Class B properties. We are trying to get more aggressive on, maybe some more, newer construction, higher clear height buildings based on just, sort of underwriting more aggressive market rent growth. We did close to 65, 70 leases last year. We feel like we have a pretty good pulse on the market and, are comfortable stretching in certain infill locations. So that's really, an area where we've targeted. We're bullish on O'Hare. We're bullish on Lake County. We're bullish on Central DuPage. We've had, good luck in all those markets, and we continue to target those, on a go forward basis. We're also, really liking, that sort of fills in, but, just outside of Cook County. I think taxes are something that we have a close eye on. We're trying to be cautious on and make sure that, we understand what the tax risk is based on purchase prices. You can't always look backwards on taxes. A lot of times you have to take what your purchase price is and how that's going to affect the assessed value, and go from there. And, we were just looking at a building yesterday in Melrose Park that had, $2.50 taxes, no 6B. Based on not even a $50 purchase price, we were looking at taxes jumping to north of $5 a foot there. When you're looking at a $4.50 to $5.50 net rent, the extra $2.50 of taxes that you could encounter when you purchase the building's tangible, and it affects returns, and I think it will affect leasability, when you do have vacancy down the road.
Well, we certainly know that property taxes are going to continue to go up. That's a very likely trend. But David, do you think we're at the peak of the market? And, the other side of the question would be, how high can sale prices go, and will they continue to rise?
I think 2022 will continue to see new record per square foot numbers on both rental rates and on the sale side, just because the underlying demand is there from the tenants to take the space. And then on the capital market side, there's so much demand for capital looking to purchase buildings. Kind of like the point Kyle mentioned earlier. I mean, a cap rate is just kind of a snapshot of a moment in time. But from a sale price standpoint, I think we do kind of market from cap rates. And as those kind of stay flat or maybe even compress a little bit more and rents go up, I think just by virtue of math, we're going to have higher per square foot values in 2022. Beyond that, I don't know. But right now, certainly the pipeline and the demand on the leasing side to support the market is there. And beyond 2022, I guess we'll see.
I agree with David. I actually think there's a chance we could just be at the tip of the iceberg. I think in 2021, you saw a lot of buildings getting leased. If you at least look at new construction, I think everything does trickle down off new construction when you look at Class B, but spaces getting leased that had pre-pandemic construction costs baked in. So, you can never fault a developer for, doing a lease where they make money. A lot of these groups were looking at potential tenants that, maybe were interested just to throw round numbers out, at like an 850 rate. That is a good deal for that developer based on their pre-pandemic construction pricing. What you're going to start to see, I think, in 2022 and going forward is all these buildings that are coming out of the ground now are looking at construction costs, and this doesn't even factor in land costs, that have jumped pretty significantly. Developers aren't eating that yield and just doing these deals for less money. That gets passed along to the tenant. And I think as you start to see the last few buildings in each submarket get leased up that were built pre-pandemic, you're going to really see a jump in rental rates on the new construction side. And then I think that's going to trickle down to Class B as well. We've already started to see it in infill markets like O'Hare. If you've tracked where the last few lease comps have gone, you're seeing 300,000 square foot deals done in the $9-10 range. That wasn't a comp for even 30,000 square foot spaces a year and a half ago. So I do think that we could potentially be, just at the tip of the iceberg here.
I would add to that too. I think one of the challenges we've had with tenants is you can't really comp deals out anymore, right? Or even the landlords will, we'll go to some of our tenants on these deals we're doing and they say, can you show me comps? And the answer is no, I can't, because rents are growing so quickly. So in one example, we kind of did a business use case where we said, okay, if you're going to utilize the ceiling height, what's back of the napkin? Let's figure out how many racking positions you can fit in each location. And even though there was a B building for $550 net that was 24 foot clear, they paid $820 for a little bit smaller A building that was new construction with 32 foot clear, because they could actually fit more pallets in there. And so when they look at it from the cost of doing business, their storage on a per pallet basis was actually lower, even though the face rate was higher. So I think, to Kyle's point, that's kind of why everything always comes off of new construction, is that's always the most efficient building for tenants to be in, at least if they're going to utilize the racking. And then, the people kind of go to the B and C stuff after that.
Yeah, I ran into Pat Sullivan at the Bulls game last week, and he shared an interesting statistic that Amazon has picked up 150 million square feet in the last 18 months, and they're going to do another 150 million square feet in the next 18 months across the country. And this trend is supposed to continue for 8 to 9 years because the demand is that. So it's all upside. I mean, can you say anything bad about Amazon? Yeah, you can go pick off their workers, because when they get there, if they enjoy their for other manufacturers or employers, they get there, they get the benefits, good wage, but they have to work probably twice as hard as they did their previous job. So other than that, Amazon really has the perfect playbook in this environment.
Adam, this is Ed. One thing I guess I was remiss, and I guess you asked about other, growing. Obviously, we've all know that trucking and truck type of uses or smaller buildings with extra land have also been a hot commodity, not only for users, but for investors. And I think that'll continue to grow. And it'll be, it's like having rail. If you have the rail and it's there, it's worth something. If you're able to do trucking and to have outside storage, smaller building on larger land sites, because a lot of communities don't want that, then I think you have a very good investment. So that's another, but it's hard to find trucking sites for, just park trucks. So if you could find it, it's a good investment.
I'd reiterate that. I think that type of zoning takes it another level past industrial. You talk about a lot of these retail centers that people are throwing around theories of getting repurposed into industrial. The biggest hurdle there is getting it rezoned. Not a lot of municipalities like the industrial zoning. The outdoor storage facilities actually take it even a step further, where municipalities really don't like that. So if you're able to find a site that is zoned for outdoor storage, that's one of our business strategies in 2022. Something we're really interested in is acquiring those type of sites, because we do feel like there is a cap on the supply due to village zoning and their lack of appetite to have anything rezoned towards that use.
I'm coming in late, Adam, so if we covered it, I'm sorry. But I understand the projection for need distribution space next 5 years is about 1 billion square feet nationwide. I'm not sure if they're specific to the Chicagoland market, but I'm told the projection is about 1 billion of distribution space needed. Relative to the trucking, you can cover, I understand, 1 billion truckers needed by 2030. And e-commerce is about a $1 trillion industry, I think, projected about the next 5 to 6 years. I don't know if about that projections for that demand for distribution, whether it's spec or consumer. I'm hearing about 1 billion square feet needed next 5 years. That's mind-boggling.
Yeah, and it's going to be a combination of like anything that has to do with e-commerce, packaging companies, transportation, construction, grocery, food delivery. Everybody just from the pandemic, it's pretty much the best thing that ever happened to industrial real estate. Everybody just orders things now. So people that were thinking about doing more e-shopping, I guess, are now doing it. Older people are comfortable with it. Everything just arrives at their doorstep. So I don't know what that projection is, but it's way up there, and it's trillions of dollars of demand, and these warehouses are going to do very well.
Well, I think what it means is moving forward that the industrial breakout session will stay on the main stage at least for the next 5 to 10 years, right? Which I think this may have been the first
As it
year.
should.
So
You must be so busy. I'm not sure everyone is because the other sessions have more people in the room than here. This is the hottest sector in our industry, right?
But it's the least sexy, so nobody likes. But that's what everybody believes, right? But I think this the best place to be is the industrial sector. Is the most amazing architectural wise to be. It's like you can see something, you can see the land, and you acquire the land, and then all of a sudden 9 months later, but not right now, right? 9 months later, you see this monster appear, but this is beautiful, amazing monster that is the heart or the lungs or a set of this community, right? That like Amazon is putting buildings in the middle of nowhere. Why? But because the people are there, they need that. So yeah, it's not the e-commerce is not gonna.
I have some reservations about the growth of Amazon. I think we're going to start seeing more automated intelligence, robotics. And
Absolutely, yeah.
You might have touched on that, sorry.
No.
But it has to happen. It's inevitable, that trend to embrace that AI.
Yeah.
And minimize that labor cost and fill that need, I would
Mhm.
think.
Robotics absolutely is getting to be the biggest thing that I've seen, and not just for Amazon, but different clients as well.
I think robotics, especially if they can figure out a self-driving semi-truck, would solve a lot of issues. I think the headwinds there is probably from a regulatory sense, right? There's a lot of states and not just the federal government that have to regulate that. So I don't see that happening anytime inside of the next, I don't know, 5 years. I think they'll probably have something that can operate, but from a regulatory sense and getting it passed where they can kind of be on the road and really start to eat into the supply side of the driver problem. I think we're going to still have this problem with us for a few more years. I agree. I think technology will be the ultimate solution, but I think the regulatory framework's moving a lot more slowly than the technology. So it'll take some time.
well, I would like to ask one last question, for each panelist here, and then we can ask, solicit questions from the audience. I would say, obviously this is a forecast event. So for 2022, what is a prediction that you have? We could start with Oliver.
Like we said earlier, it's just the tip of the iceberg. It's gonna go. Last year was just the beginning, and it's gonna go and grow a lot more this year and in the next few years.
I agree with that. I think you'll continue to see escalated growth, and we'll also, continue to have constraints on the supply side as far as delivery lead times and trying to find creative solutions for that. I think you'll see a lot more solutions towards some of the issues we're having sitting here today a year from now.
I think we'll see with more regularity sub-4 cap rates on new construction sales and double-digit net rents, especially in the core submarkets.
And, I do think the Chicago Bulls are going to win the NBA championship. So they got the team to do it. I think the pandemic's going to end. And I know Jay Dice and Greg Terwilliger are here in the audience and can attest that the last 2 years I sat on this panel and predicted they'd be the best years ever. They were, but it wasn't for the reasons I thought it would be. So I'm just lucky. But I don't think the party's going to end. I've been in this business a long time, and for a long stretch, it wasn't fun anymore. You do a deal and both sides would be unhappy with the outcome. Now it's kind of fun again. And it's like there's lots of deals and young brokers are coming into the business and they're learning quickly and they're thrown into the fire and it's exciting. So my industrial real estate prayers have been answered and I don't think it will end anytime soon.
And I really don't have anything to add to it. I think everybody's said what they needed. I know I've got some developers that I'm working with that said that the market's going to tank. So everybody back off so they can buy the property. No, I'm just goofing around. But I think yes, it's going to be a great 2022.
All right, well, we'll open up the floor to questions if anybody has any questions for the panel here. Greg.
So if you had, say, a 500,000 square foot build to suit that right now and be in by the end of the year, 2022, where, what state you can do, you can't get the school out in Chicago and they can go to the Midwest. Where did they get that deal done?
I think they have to look at existing inventory for the delay of construction materials, as Elbo was mentioning. So I-57, there's 800,000 square feet that Logistics Property Company has, and Hillwood has 1 million in Moni, and CRG is developing 1 million, the cubes at intersection of 57 and I-80. So it's existing inventory. Otherwise, you're rolling the dice. I'm just learning that you cannot price roofing.
No.
You have to sign a contract. How does that work? And you just roll the dice.
I think Kyle has a better way to explain it.
Yeah, you sign a contract based on a projected price, and then when it shows up, you get the bill, and it could be anything.
No complaints.
Yeah, no complaints. No. No.
They'll upsell it 10% to the next person.
I have a building right now going up and I have a temporary roof. I can't find a roof. I mean, we have it now, but it's not going to go up until March and the building is up. So it is interesting how things are happening.
There's a lot of leaning on existing relationships with subs that is going on in the GC and then in world right now. That's, I think, as important as ever.
But we can talk and we can find you something.
All right, any other questions? All right, well, I'd like to thank our panelists and everybody here for joining us today at the industrial breakout session. So I hope that everyone has a great rest of your day and a very successful and happy 2022. Thank you.
Yeah.
Thank you.